Well, I don't know if you remember, but the Federal Reserve is meeting next week, so we're trying to figure out what in the world are they going to do. Are they going to continue to rally interest rates to the highest level that we've seen in maybe 30, 40 years? Well, that's what we're going to talk about in today's video. So what you're seeing on your screen right now is where mortgage rates are on the top 6 products people use when they're buying their first house. I'll get to that in a minute because I want you guys to understand what the Federal Reserve's most likely going to do next week when it comes to interest rates. So to do that, we look at the economic calendar, we look at the markets overall, and that's what we're going to do right now. So the first thing we want to look at is the economic news that we have out today. Well, there's a couple things that came in. Some of these things came in pretty good. It shows the economy is still really robust, and those numbers are core durable goods are up. They're staying steady. Last reading was they were up 0.5. Economists thought they were going to tick down to about a 0.2. They stayed steady at 0.5. GDP, how much production we're getting out of the U.S. Well, that is spiking to levels we haven't seen in a long time as well. Our last reading was 2.1. They expected the economy to grow and durable goods orders to grow to 4.3. It actually came in a little bit higher than that, just shy of 5%. We haven't seen that number in a while. Here's the number that the Federal Reserve might be applauding. They want this number to get to about 300,000. Here, let me give you their thoughts behind this. Here's what the Federal Reserve wants. They want basically people to lose their jobs, companies to start slowing down just to curtail inflation. Their thought behind this is, well, if you're not working and you're not getting that steady paycheck, you can't go out there and buy stuff. Well, if you look at the domino effect of that, if you're not buying as much stuff, you're going to have companies needing to lay off because they're not meeting their earnings. So that's another area that I want to really show you guys, or a little bit of focus in on that. This week, just yesterday alone, what I did is I Google searched the S&P 500, the top 500 companies in the S&P or in the U.S. right now, how their earnings are coming out. Are earnings starting to really deplete where we might be starting to get a little concerned that companies can't meet their financials, so they're going to really have to start laying off people? If the first thing if you go over and you figure out what company it is. So these are the top, say, 25 companies on the chart right now. If you look over to here, you're going to see what they did on their earnings. This one came in a positive. Look at every one of these came in a positive except for that one right there. So companies and earnings reports are coming in really good. I think this is going to start to deteriorate. You're probably going to see the stock market ease off from the high levels that we have right now because, again, what the Federal Reserve is doing. So now let's go over and see what is the projection that the Federal Reserve is going to do at the next meeting. So are they going to keep raising rates, or are they going to kind of take a back seat and let the markets try to wiggle their way through this? So to find out that, what we want to do is we want to go over to the CME FedWatch tool. This is actually a website that the Chicago Mercantile Exchange created to give us some guidance on what the Federal Reserve is going to do at the next meeting. If you see through here, the next meeting is 6 days, 3 hours, 35 minutes, and 59 seconds. Well, 34 minutes and 59 seconds. What this tool actually is what is the likelihood that the Fed will change the federal funds target rate at the next FOMC meeting? Well, right now, the Federal Reserve, what they control one interest rate, and that rate is the federal funds rate. Okay, and a lot of interest rates pivot around that rate. But right now, the current rate on the federal funds rate is 5.25 to 5.5. There's a little spread there. Okay, so what I want to show you next is a slide down below. It's a little surprising. It's a little bit of a change than we've been seeing lately. If you scroll down this chart, usually we see in this category here, right over in this section, you'll see where the number is, the probability of what they're going to do at the next meeting. And then you're going to see what the probability is of them doing at the next meeting. Well, here, let me get to it. What you're seeing right now is the federal funds rate is 5.25 to 5.5. So it's right there. The probability that it's going to stay there, the Federal Reserve is going to do nothing, is right there. There's a 98% probability they're not going to do anything. The intriguing part of this is the column right over here. This is finally telling us the Federal Reserve might be in the mood or might be in the projection of starting to reduce rates, what we call the pivot. Okay, so this number usually isn't here. This category usually isn't here. Usually it's on the opposite side, giving us guidance that the Federal Reserve is going to increase rates. Okay, so right now there's a probability, 99% probability that they're not going to do anything. And now we have just shy of a 2% probability that they might cut rates. Do I think they're going to cut rates? No. Does the markets really think they're going to cut rates? No. But if we go over to here and see what the probabilities are that they're going to do at the next few meetings, we're seeing right through here the probabilities basically are coming off the charts or off the markets of them increasing rates, where you see in this category through here. So let me explain this chart. Right now, we're at 5.25 to 5.5 on this chart. It's saying the November meeting, there's a 98% probability they're not going to do anything. Next meeting, there's a 75% probability they're not going to do anything. As we move over to 2024, you're starting to see this coming down, stating, well, the Federal Reserve most likely next year is going to pivot and start to reduce rates. So that's what we're looking at on that front. So based on the economic news we have today, the limited information we have, what in the world is going on with mortgage rates right now? Well, to do that, we want to go over to the bond market. What the bond market is telling us right now is this is what we focus in to give you basically a futuristic look on where mortgage rates are going to go. So to do that, what we do is we focus on what the mortgage bonds are doing. So this bond right here, you'll see it's an MBS. It's a mortgage-backed security bond. What is it? Well, when mortgage companies do loans, they package those loans up into big bundles and they sell off those loans to Wall Street as mortgage-backed security bonds. Okay, so people buy these bonds. What you're seeing right now is this is the price of the bond, and this is what's happening with it. But let me give you the context of how this works. If the bond price in this scenario that you're seeing right there through here, if the bond price goes up, and that means yields are coming down. If the bond prices go down, which we've seen in the last 2 years, we see interest rates go up. So let me kind of dissect this and explain to you exactly how it works. So in my scenario, let's do this. Let's kind of take two extreme approaches. Let's say, for example, well, a mortgage-backed security bond, when it comes to maturity, that bond is going to be worth $100 for the bond, the individual bond. Okay, so let's say in today's market, I offer you $50 for that bond. Okay, so I give you $50, and next year when that bond matures, you're going to give me my $100 face value of that bond back. Okay, so I paid you a low price. What's the yield on that? I gave you $50, you give me $100 back. My yield is 100%. I doubled my money. Okay, so now let's push up that price, because remember I was saying if the price goes up, the yield comes down. So let's make the other extreme. Let's say, for example, I give you $100 today. Next year when the bond matures, you give me $100 back. What is my yield at that point when I paid you a higher price? The yield on that now is 0. I gave you $100, you give me $100 back. So do you understand how bonds work when it comes to the price and the yields? So we love when this price goes up. We're up about 45 ticks right now. That is great for the markets. We're going to see interest rates ease off a little bit. So where are mortgage rates right now? Well, these are the top 6 products people use when they're buying a home, especially their first-time home. These rates are issued by Mortgage News Daily on a daily basis. The criteria behind these rates is this. This is structured on somebody that's a first-time home buyer, buying a primary home, and it's a single-family home. Those 3 criteria, and then there's 2 more. One is they have a 740 credit score, and they're putting down 20%. Now, you don't need to put down 20% when you're looking to buy your first house. Most people, when they're buying their first house, they average between 3 and 3.5% of a down payment. So if you're out there and you're like, Dan, how can I navigate this market? How can you educate me on buying my first house in today's market? Well, great question. All I need you to do is go visit us on the web. It's therateupdate.com, and here it is. There's 3 different ways you can apply. The first way is click the Apply Now button. We're going to ask you a series of questions to make sure we assign you to a mortgage specialist on my team that's right in the realm of what you're looking for. Or if you're like, Dan, I'd love to call you guys or maybe just email you, well, you can do that as well. What you'll do is you'll go down through our website, and there's a whole bunch of information that you might find here very informative, especially if you're a first-time home buyer. You scroll down through here, there's mortgage calculators, blogs, and a bunch of other tools. But at the bottom of this screen, you're going to find 2 other things. You can give us a call at 844-775-5626, or you can email me personally at dan@therateupdate.com, and I'll reply, I promise. Thanks so much for watching, guys. God bless. Have a fantastic day. I'll see you tomorrow. Bye-bye.